Hello everybody, welcome to Ask a Fund Manager. In today's video, I'm going to be talking about how do you know whether dividend is safe or not. A lot of people want dividend stocks, and I don't blame them. Bond yields suck right now. There's no return in buying bonds. Inflation is probably going up, and you want to have some sort of actual cash return as a substitute for your retirement, so you don't have to be always selling assets or trading strategically and worry about capital gains, and you can collect an actual cash on cash income. And cap rates on real estate aren't that great either, particularly in more expensive markets such as where I live in California. So because of that, dividend stocks are attractive on a surface level, but not every dividend is safe. It's particularly companies that pay high dividends. And I'm going to go into some of the factors that I would look at for that. But before I do that, I want to disclose that this is nothing on this show or this video is investment advice. It's for educational purposes only. Please do your own research or have an investment advisor help you with that. Now with that out of the way, let's go talk about what to look for. So if you find a stock that has a high dividend, and I get asked this question a lot by clients who are either worried that a dividend is going to get cut on a position they're holding, or they're worried that they're in a position that is affected by this, or they think that's an opportunity of this. They find a stock that has a dividend. It's like, hey Nick, this might actually be a great opportunity to buy this stock because it has a high yield, and that should attract investors to have capital gains too. But we have to make sure that the dividend is sustainable and not risk getting cut. Because what happens, and I remember following this during a few energy stocks this happened to in 2015-ish, when they had the previous big energy bust due to the shale oversupply problem. You had a lot of companies that were paying really great dividends, and then when they decided to cut, the stock would drop 30 to 50% overnight on the news, because a lot of the reason why people were buying that stock was mainly due to the generous dividend. And if they're not collecting that income anymore, they're like, why do I want this crummy oil stock that doesn't have good fundamentals outside of a dividend? And therefore, you just have everybody go out the exit at the same time, which is one of the dangers of investing in dividend stocks. So how do we know whether a dividend is going to get cut? First thing you got to look at is cash flow. Is the free cash flow and operating cash flow enough, not just to cover expenses, but to cover your dividend payout and a little bit of buffer in case you either need to finance growth or pay back some principal on debt, or have to pay a higher interest rate on your future debt. There's a lot of reasons why you may need some extra cash. So first of all, is there enough cash to cover the dividend and operating the company? If the answer, this not necessarily means the dividend is safe, but if the answer is no, it means the dividend is probably not safe, and the odds of a cut are very high. That's the first thing. First of all, what's the payout ratio? Among the payout ratio, unless if it's a REIT, you don't want the payout ratio to be too high, because if they're paying out all of their income, net income on dividends, or more than their net income on dividends, that sometimes happens, that puts the company in a dangerous situation. And if revenues do go down, or if interest expense gets higher, or some other exogenous shock happens and they need cash, the dividend's gonna have to go or get cut. And therefore, that's not, for an income investor, it's not nearly as attractive as it was before. So that's the second one, is payout ratio is a thing to watch. Another thing to watch too is what are the sustainability of those cash flows. But is it a company whose sales are growing, staying the same, or declining? If it's a dying industry, and say for example, I'll use say a Palm Pilot manufacturer, or something like an old obsolete product that people don't use anymore, and if they pay out a great dividend and they have the cash now because there's still some remnant older users of this product that they have, But if people continue to buy less of it and sales are going in a downward trend until nobody buys the product anymore, it's just a matter of time before that dividend gets cut and the cash flows fall below the dividend. I mean, there are some value investors that do something like this called cigar butt investing, which is the term that, yeah, it's probably a dying business, but the thing is, will it generate enough cash over the next 10 years and through dividends to pay more than the price of the stock that I'm paying now? And if that answer is yes, then that's still a good proposition, even if the company does go bankrupt. If the answer is no, then you're probably going to lose. And that's something you have to assess with dividends. Like, is the fundamental core business sustainable? And second, are the yields high because there's just negative sentiment on a sector? Or are they high because there's structural fundamental problems? And this is sometimes tricky to ascertain. Like an example is right now, we're getting a lot of high dividends in the oil sector just broadly. And a lot of people think, oh, it's because oil's not coming back. It's going to be replaced by electric cars and green energy and clean tech and all of that. And if you believe that, and a lot of the people in the market believe that, those dividends are not high enough to take the risk in buying traditional energy companies because they won't be around in 20 years. Or there's the other side would say, hey, look, oil is going to be here. Oil needs to be much higher at a per barrel prices to make alternative energy competitive without subsidies. And even in the best case scenario, you still got another 25 years of profits at very high levels, and these dividends are paying very generous yields. So that might be an opportunity to buy, like when everybody's just down on a sector. These are probably usually the times when high dividend yield buys they make the most sense. You want to buy the best companies in a sector where everybody hates, and the reason for their hating it is either fully priced in or it's just inaccurate. And energy right now is kind of the battleground for that, conventional energy. I'm not going to really go into my personal opinions on that, but if the things you are getting paid for a high dividend yield to make a bet that the energy industry will be here to stay. And every time you see like a sector that's weak for various reasons, that's where the opportunities to get longer term high yield if that industry survives. So those are kind of some of the variables that I would look at. I mean, you get cash flow, payout ratios, sector versus idiosyncratic risk, and there's many others too. And they depend usually on the specific fundamentals of the company, but you need to make sure the company's just going to stay profitable long enough to keep it going. And if it does, usually that high dividend stock will not be a high dividend stock anymore because the price will recover and it will go back to the mean, around the mean of the market or the mean of its sector. And if it's not, it will continue to go, the stock price will go down and you'll get your dividends cut, which will create a reflexive spiral down, which will cause the stock price to go down more, and then people to be less willing to finance the company and or have to at higher interest rates, and then they'll have to cut the dividends. So the effect of these dividend cuts tend to have reflexive considerations. So also keep that in mind. Hopefully that answers your question. If you like this content, please like and subscribe and share this with your friends. And I look forward to doing more. And if you have a suggested topic or a question, either email us at askafundmanager@gmail.com or type in your question in the comments. Thank you for watching.